Yes, I am with Mr. Ashok Tyagi in one of the DLF properties in Gurgaon to talk about the new DLF, as they like to talk about it. Mr. Tyagi, I've been tracking this company since you IPO'd nearly 12 years ago. The major overhang has been debt. After this QIP of 3,200 crore rupees, the second leg to make DLF debt-free, where does that stand? Is DLF indeed debt-free, or by when will it be completely debt-free?
So in all fairness, the debt issue, frankly, is really yesterday's story. I mean, if you saw our books on December 31st, our net debt was about 7,000 odd crores, which with the QIP and the residual promoters' contribution will be a number which will almost be about 2,000 odd crores. There will be some additional liabilities towards land and all, but I think our debt equity now is a number which realistically by June end should be less than 0.1:1, which frankly is almost zero. From 0.1:1 to actual zero might be a story of another 2 or 3 quarters, but honestly, those numbers have now become irrelevant on the debt side. So I think the debt issue is frankly now behind us. That overhang is gone. And hopefully now we can actually, with this lightweight from a leverage and gearing standpoint, hopefully come back into a growth mode.
So, Mr. Tyagi, if I could borrow DLF's own slogan, Building India, now that you don't have this pressure of debt on your P&L, on your balance sheet, tell me more about DLF 2.0. You've been holding back on launches. You still have inventory, nearly 13,000 crore rupees, unsold, completed inventory. What is it that we can expect from DLF in the new financial year? For example, will this real estate major come back to launching projects?
Okay. So one thing we have made pretty clear, even during the interactions we had in the last couple of months with analysts, with investors, etc., is that given the entire regime and uncertainty, etc., what we intend doing is going forward, we will launch projects. We will begin launching for construction, but the launching for sale will only happen at a late stage, which is on or close to the entire completion happening. That's primarily because everybody believes it's because on account of regulatory issues, but actually it's more on account of the fact that I think the customer, given the kind of experiences they have undergone with multiple developers across the country, deserve a zero risk when they are buying a product, and that's what we want to be. Obviously, the next round of construction has begun. I mean, the project that should hit the ground running first is the next phase of our Central Delhi project, which is now in a JV with GIC. For the next 3 odd years, we have the existing inventory of about 12,000 crores. We believe that the 12,000 crores inventory should liquidate in a period of between 3 to 4 years, depending on the pace of sale. And I think by that time, the next generation of projects should be available for bringing to the market, which should be Capital Greens, which should be our JV that we are doing with Heinz in Udyog Vihar, which is a commercial project. We are planning to launch another commercial project in New Gurgaon. And at some stage, with Crest now almost running out, we'll also launch the construction of the next phase 5 project after Crest.
Crest is, of course, in Gurgaon. It's a premium project by DLF. So is that your guidance to investors and to the stock markets, that there will be sales about 12,000 crore rupees in the next 3 to 4 years? In a nutshell, that is what you're saying.
That is absolutely correct. On the commercial leasing front, obviously, we continue to grow aggressively. We have a project in Delhi and a project in Chennai, which is almost commissioning this year. We have lined up the next round of projects, and we believe that between Hyderabad, Chennai and Gurgaon, we should be almost doing about 10 odd million square feet of projects in the next 3 to 4 years.
Mr. Tyagi, another important development besides the DLF QIP in the quarter has been of India's first REIT listing by Blackstone and Embassy. Does DLF have any plans of reaching out any of its commercial real estate projects? Is anything on the horizon?
So we are delighted with the fact that India's first REIT has finally got off the ground and had a very successful launch. Honestly, frankly, the REIT and the DLF QIP, which is almost 8,000 crores of investments coming in barely within 8-10 days of each other, again reinforces the trust that investors have in India's real estate sector. From a DLF standpoint, as you know, about a year back, we did the entire JV with GIC. So in some sense, it's like a private REIT. We believe that at some stage, GIC and us will decide to do a part REIT within that portfolio. But that may not happen, at least in the immediate foreseeable short term of 2 to 3 years.
So for 2 to 3 years, we may not see a REIT listing. Yeah. Mr. Tyagi, about 7-8 years ago, there was an enforcement by the company to be in the affordable housing space. Now, a lot of action on the regulatory front, whether a GST at 1%. Is that a space that DLF will once again look at? You had reworked your projects and decided this is a space you didn't want to be in.
So in all fairness, if you look at like a DLF between 2009 and 2013, we did almost, I don't know, maybe 30 odd million square feet of across the country of mid-range housing priced between say 2,000 to 3,000 rupees a square foot. Frankly, I think given the construction cost escalations, etc., we did not sort of enjoy the margins that we made in those projects. So yes, at some stage, is there a scope in our entire portfolio for doing a mid-range housing? The answer is yes, but I think we would have to look back at our toolbox of execution, because the issue is frankly that with our entire compliance requirements, with our contracting requirements, do our costs stay competitive in that segment? And I think we need to fix that. But at some stage, obviously, we have enough land banks which lend themselves naturally to mid-range housing, frankly.
Are you going to come back into the market as a land buyer? We had seen a slowdown. We started seeing a pickup again after the first fundraising drive last year. Is DLF back to buying land?
No. So last year after the first fundraising, we did buy off of the e-auction the land from HSIDC, and honestly, that was less to do.
That's in Haryana.
That's in Haryana. Sorry, and that was less to do with land buying or land aggregation, and more because it was a parcel contiguous to our sort of strategic cyber city. So frankly, we are not out in the market, looking for stressed assets or land. We, I mean, as you know, have enough land bank. I mean, I think we have in excess of 200 million square feet developable area. But if there is something that we need to do for contiguity or something that is just too strategic or bang in the center of our developments or something, we might still look at it. But as a rule, we are not looking in the market for
So you have enough land bank. Mr. Tyagi, I want to talk a little bit about pricing. Where is pricing? Has pricing stabilized? Is it going up? Is it going down in residential? What has been the trend so far? We're also in election season. There is uncertainty. This is an economy that has had to deal with a blow for real estate in the form of, let's say, demonetization as well. Has there been recovery? Because we keep hearing about how sales are not back. It's still a buyer's market.
So honestly, frankly, we've always maintained that if you look at the more secular secondary market, I think the secondary market, the prices have tended to stabilize now, maybe marginally inching northwards again. In the primary market, which is where we operate in, obviously, we believe that if you have the right completed product and at the right location, be it a Crest or a Camellias or even, smaller projects in Lucknow that we sold in December, the market has at least started returning in a strong way. It might still not be the cowboy years, as I call it, but clearly I think the market is there. We, as you know, from our standpoint, we have been averaging about 600 crores of sales a quarter, which is a pace which sort of, coming back from almost a zero a year and a half back is decent improvement. We expect it to kind of sustain and improve across the next couple of quarters. So sales are returning, but the projects have to be completed. They have to be at good locations, and they have to be at a price point where, so honestly on Crest and Camellias, there are two, the central projects, the prices have only been strengthening, frankly.
Okay, so prices have been going up.
Yeah, absolutely.
Commercial real estate is a strong indicator of the economy. Are lease rentals going up?
Yes, the lease rentals and the lease offtake are both going up. The mix of clients is gradually moving. So like in Cyber City today, you will have less of IT and ITES and BPOs and more of the BFSI and corporate offices and consulting companies and, those sort of people coming in. But overall, Cyber Park, which is our new 2.6 odd million square feet development across the Cyber City in Gurgaon, has almost hit a complete pre-leasing now at rentals which are now well into into 120-ish range. We know the rentals that are on the golf course road, in the horizon. So clearly rentals are strengthening, even retail malls where we don't have vacancies right now, but we are operating at near full capacity. The revenue shares are increasing. So clearly both the retail and office segment have a buoyancy about them right now.
I want to now talk a little bit about the balance sheet. You're saying debt is a non-issue. It's at 2,000 crore rupees. The promoters have shown commitment to DLF. Perhaps one of the few promoters we've seen the kind of commitment of selling their shares and infusing money into the listed entity and the holding company. Mr. Tyagi, I want to now understand that with this balance sheet being healthy, will DLF go back to markets? You have flirted with the capital markets 3 times. You've tapped the capital markets 3 times. The Cyber Park you were just talking about, that mega commercial project, the pace of construction. Will we go into another fundraising drive?
No, I mean, if you really see the last two fundraising drives, both the IPP that happened in 2013 and the QIP that happened now, were primarily necessitated by regulatory issues, frankly. In this case, because the promoters wanted to invest the 11,000 odd crores from the game changer transaction into the company, they would have reached 75%, so a QIP was required. Similarly, in IPP, the public float norms changed, so the IPP was done. So as we speak right now, I don't think we have either the requirement or the need or the inclination to go in for a fresh public fundraising immediately. Yeah.
Start of the new financial year, any guidance you want to give us for the year when we talk about the bottom line and top line?
So as we've said that we believe that our top line, which would be, I don't know, ballpark about 2,400 crores last year, 2,350, 2,400, should grow at 10 to 15% in the coming year. And if you look at our April to December profit that was about 900 crores for those 3 quarters. So I obviously can't guide you for the Q4 profit, much as you would trap me into doing it. So we believe that a healthy clip on both profit and top line growth should sustain.
I won't trap you, but I'll ask you straight up. The infusion into the company will obviously come in the Q4 numbers.
Yeah. So it will reflect in the cash in hand number in Q4. You're right.
On the cash in hand. Yeah. So okay, so that's I won't trap you like.
So the net debt number would reduce.
The net debt number would reduce. And any plans for reducing that balance 2,000 crores? Because Mr. Tyagi, if you're going to be launching new projects, you might not sell them. Where is all the money going to come for that construction? Will you fall back into the debt trap?
No. So really, I mean, if you look at it, we have about 12,000 crores of the residual inventory that is there. We have about 3,000 odd crores of residual receivables from the sales we have made, and about 2,300 odd crores of the residual construction and capex that we need to incur for those sales. So really, the 12,000 crores that comes in really has no construction liabilities linked with it. I mean, it will have its routine overheads and whatever residual small interest there is, but there's there are no construction liabilities. So frankly, we believe that that should be more than enough to handle the construction cash flows. Obviously, the couple of JVs that we have, like the Heinz JV, are non-consolidated JVs, and they might need to take debt for their construction, which would not be consolidated. But yes, those SPV level debts could still be there, but at the listed co entity, we don't foresee that debt number going up.